Discounting, asset valuation, and monetary policy. Plan of the talk. We will cover three parts. The first part is about discounting and asset values, how discounting affects asset values. In the second part, we will discuss the discount rate in equity market. The third part, we are going to discuss the theory of discounting and monetary policy. Discounting and asset valuation. Short-term and long-term impacts of monetary policies. Monetary policies are the main tool governments and central banks use to fine-tune economic activities. Lower interest rate will stimulate short-term economic activities. Lower interest rate will also push up asset values. This makes people with more assets, typically older people, wealthier. This also makes people with less assets, typically young people, less able to acquire housing and other assets. This makes young people difficult to establish families. We will explore these issues in detail. Interest rate, monthly payment, and housing price. Low interest rate policies often used to lower mortgage payments. This makes housing more affordable over short term. But same policies often make housing prices higher. Over long term, does low interest rate policies make housing more affordable? Example 1. Suppose a house is bought for $400,000. The required down payment is 5% of the house price. The rest of the money is borrowed through a 30-year mortgage with monthly payments. What is the amount of down payment? And what is the amount of borrowing? The annual percentage rate of the mortgage loan is 6%. Calculate the monthly payment. Now suppose government try to make housing more affordable. It reduced interest rate to 3%. What is the new monthly payment on mortgage? Does government policy improve the affordability of housing market over the short term? If the housing supply doesn't increase, those who can afford the monthly payment of the original $400,000 house will likely to buy the same kind of house. Suppose down payment is still 5% of the housing price. What will be the new price of the house, which was originally sold for $400,000? If monthly payment is capped at the same level when interest rate was at 6%, what is the new down payment? Over the long term, will lowering the interest rate alone improve or deteriorate the affordability of the housing market? Solution of the problem. The down payment for the house is 400,000 times 5%, which is the percentage for down payment. It is equal to $20,000. The amount remaining, that is the amount of mortgage, is 400,000 minus 20,000. It is equal to $380,000. The number of mortgage payment for a 30-year mortgage is 30 times 12. is equal to 360 payment. Monthly interest is equal to annual interest divided by 12, which is equal to 0.005 or 0.5% per month. The formula for calculating the monthly payment, is the following formula. This is the most widely formula in all finance. Here, the parameter values are total mortgage PV is equal to $380,000. The number payment, which is N, is equal to 360. The monthly interest rate is R is equal to 0.005. With these parameter values, we can calculate the monthly payment A. It is equal to $2,278. When the interest rate is reduced to 3%, we can redo the calculation with the same formula but different parameter values. The parameter values of PV and N are the same, but the monthly interest rate is reduced by half into 0.0025. Then we can calculate the monthly rate. A is equal to $1,602. Over the short term, the low interest rate policy improved the affordability of housing. I mean, the new monthly payment is lower than $2,200 when the interest rate was 6%. However, people who can afford the original monthly payment can continue to pay the same amount. If there's no new housing supply, people will continue to pay the same amount for the same house. To maintain the original monthly payment of $2,278 with a 3% interest rate, the present value representing the stream of payment is PV equal to A. It's the same formula. Okay. The parameter values are the monthly payment A is equal to $2,278. The number payment in 30-year mortgage is N is equal to 360. And the monthly interest rate is R equal to 0.25%. We can calculate the PV, which is the mortgage. It is equal to $540,386. From the above calculation, total mortgage becomes more than $540,000, which represents 95% of the housing value. Housing value is therefore 550 divided by 95%, which is equal to $568,000 and more. With this housing price, the new down payment, which represents 5% of the housing price, will be 568,000 times 5%, which is equal to more than $28,000. This is higher than the original $20,000 down payment. Discussion. Over the long term, low interest rate policy will deteriorate instead of improve the affordability of the housing market. There's no magic in financial policies. Short-term benefits have to be paid by the long-term cost. Specifically, short-term low monthly payments have to be paid with long-term high housing prices. From generational perspective, higher asset value for the current generation increases the barrier for housing ownership for the future generations. Now we are going to discuss another type of mortgage, adjustable rate mortgage. In adjustable rate mortgage, which is called ARM, payments are adjusted during the life of the mortgage. There is no down payment for ARM. Typically, in the first several years, only interest part are paid. After several years, principal is amortized together with interest payment. This greatly reduced the cost of house buyers for the first several years. ARM, or adjustable rate mortgage, is very popular for several years before 2008 financial crisis. Example 2. An example of ARM. A house is bought for $500,000. The mortgage rate is 3% per annum. The buyer chooses adjustable rate mortgage that lasts for 25 years. In the first 5 years, the buyer only needs to pay the interest part. In the next 20 years, the buyer will pay back interest and principal with an equal monthly payment. What is the monthly payment for the first 5 years? What is the monthly payment for the next 20 years? Why people often default on adjustable rate mortgage? Suppose the housing price appreciates 15% over 1 year. If the capital investment is measured as a first 12-month mortgage payment, what is the rate of return from this investment? Solution of the problem. The monthly rate of the mortgage is the annual rate divided by 12, which is equal to 0.25%. Monthly payment for the first 5 years, which is interest only, is equal to $500,000 times 0.25%, which is equal to $1,250. Monthly payment for the next 20 years, which includes interest payment and principal. We use the same formula, right? The monthly payment is equal to the total housing value times R divided by 1 minus 1 over 1 plus R nth power. And we plug in these parameter values, we get the monthly payment to be $2,773 per month. This is more than double the monthly payment for the first 5 years. Solution of the problem continued. People default on their mortgage because the monthly payment jumps greatly after 5 years. If the housing prices appreciate 15% in 1 year, the amount of appreciation of the housing price is 5 million times 15%. It is equal to $75,000. The amount of investment in 1 year is $500,000 times 3%, which is equal to $15,000. Return on investment is 75,000 divided by 15,000 minus 1 equal to 4 or 400%. Or equivalently, use 15% divided by 3%, which is the percentage of appreciation divided by percentage of interest rate and minus 1. Again, we get 4 or 400%. So the return on housing investment is 400% a year, which is extremely high. We have put the above calculation into an Excel sheet. You can download the Excel sheet from this website. The following slide is the summary of the result. We have a housing price, $500,000. We got mortgage rate, annual mortgage rate, 3%, which means a month rate of the 0.25%. The monthly interest payment for the first 5 years is $1,250. The duration for payment in principal and interest is 20 years because the total mortgage is 25 years. For the first 5 years, it is the interest-only payment. The payment period for the interest and principal is 240. This means the number of monthly payment in 20 years. So 240, which is equal to 20 times 12. And we can calculate the monthly payment for the last 20 years to be $2,773. Suppose the percentage of capital gain is 15% in 1 year. The amount of capital gain, which is $500,000 times 15%, is equal to $75,000. The capital invested is the 12 months of monthly payment, which is $15,000, and the rate of return is 400%. Highlights of the solutions. The housing price is $500,000. There is no down payment. Initial monthly payment is only $1,250. It is cheaper to own than to rent. This is why so many people choose to buy houses with ARM. After 5 years, the monthly payment rises to $2,773. $773, more than double the initial payment. This is why many people default on their mortgage. Highlights of the solutions. Continued. The rate of return on housing investment is 400% a year. It is an extremely high value. This is why investors love buying houses with ARM. Since ARMs are so popular with the customers, banks love to provide service to earn high income. There is little incentive to be more prudent. Discussion. Many adjustable rate mortgages were initiated after 2001, after the burst of tech bubble. Housing market peaks at 2006, about 5 years after 2001. Default occurred in a large scale from 2007 to 2008. Are there any relations? The movie and book The Big Short offer good stories about that period of time. Bond price change with different maturity. Bonds have different maturities. Some mature in 5 years. Some may last for 30 years or even longer. When interest rate changes, bond price changes, but amounts of change are different for different bonds. How the price changes are related to the maturity of the bond. Example 3. There are two zero-coupon bonds. The principal of both bonds is $1,000. The maturities of two bonds are 5 years and 10 years respectively. The initial interest rate is 8% per year. What are the prices of the 5-year bond and the 10-year bond? When the interest rate declined to 6% per year, what are the new prices of the two bonds? What are the percentage changes of their prices? This is a simple calculation. We put the results on Excel calculations. For Excel calculation, please check the following web link. The following slide is the summary of the results. Maturity of two bonds. One is 5-year, the other 10-year. Initial interest rate is 8% per year. Initial price for zero-coupon bond. One is 680, the other is 463. Then the interest rate declined to 6% per year. The new price for zero coupon becomes 747, the other is 558. The percentage change for the short maturity bond, 5-year bond, is 9.8%. For 10-year bond is 20%. So the percentage change for the 10-year bond is larger. Conclusion. Long-term bonds are more sensitive to interest rate change. In general, long-term projects are more sensitive to environmental changes. Securitizing long-term mortgages. Financial industry securitize long-term mortgages into mortgage bonds. They sell the mortgage bonds to many different investors. This reduces the risk of mortgage originators, such as banks. The reduced risk increases issuance of mortgages. The demand for more mortgages increases housing construction and increases the size of houses. Increase of the size of the housing market increases the leverage of the economy. This sowed the seeds for large-scale financial crisis. 2. How to determine discount rate in equity market. Equity market is an extremely important market. How we can determine discount rate in equity market? Mainly, there are two methods. The first is CAPM. CAPM doesn't provide quantitative measure of the expected market return. We usually approximate it with historical return. The second method is discounted cash flow method. Theoretically, they should yield the same result. What are the empirical results? Pharma and French 2002 paper, Equity Premium, provides a summary of the long-term empirical results in the U.S. equity market. This table is the summary of Pharma French 2002 paper, Equity Premium. Pharma and French subdivide the time period into two sub-periods. One is from 1872 to 1950. The second part is the second half of the 20th century. So in the first part, the dividend ratio is 5.3% and dividend growth ratio is 2.7%. Together, they make about 8%. And every S&P return is also about 8%. So they are roughly the same as we have expected. However, in the second period of the 20th century, the dividend ratio is 3.7% and dividend growth rate is 1%. Together, they make 4.7%. But at the same period time, the average S&P return is 9.6%. So this is roughly 5% higher than the cost of equity from DCF approach. Discussion. From 1872 to 1950, cost of equity of the whole equity market calculated from DCF is 8%, and cost of equity calculated from historical return is 8.3%. They are pretty close. From 1951 to 2000, cost of equity of the equity market calculated from DCF is 4.7%, and cost of equity calculated from historical return is 9.6%. The annual difference is almost 5%. The results from these two methods are very different. Observation. In discounted cash flow approach, there is no risk premium. In the end, risk is not priced in DCF approach, but in CAPM, risk is priced. How can we reconcile these two different methods? One way is to try geometric return. Geometric return combines return and risk. Next, we are going to discuss theory of discounting and monetary policy. Concept of discount rate is central to economic analysis. Because of this centrality, the choice of an appropriate discount rate is one of the most critical problems in all of economics. And yet, to be perfectly honest, a great deal of uncertainty will cloud this very issue. The most critical single problem with discounting future benefits and cost is that no consensus now exists, or for that matter, has ever existed, about what actual rate of interest to use. The main problem in the theory of discounting is that an economist who knows the literature well is able to justify any reasonable social discount rate by some internally consistent story. There are some puzzles about discount rate. The first puzzle I'm going to talk about is the following. The borrowing rates for banks are very low, but the credit card interest rates that banks can charge their customers are very high. How can the large interest rate differential be maintained over a long time? From another perspective, individuals can obtain a line of credit or mortgage at a much lower interest rate than the credit card interest rate. Why do so many people still maintain a large amount of credit card debt without replacing it with a line of credit or mortgage refinancing? Puzzle 2. Most economists are staunch proponents on efficiency of the markets, especially when a market is very liquid and transparent. The short-term money market is among the most liquid and transparent markets in the world. Yet, most economists support that short-term discount rate, possibly the most important factor affecting economic performance, should be determined by a small group of independent professionals from central banks. Does that mean the market is only capable of being efficient on minor issues and not on major issues? Puzzle 3. In general, yield curves slope upwards. Loans with longer maturity pay higher interest rates than loans with shorter maturity. At the same time, empirical evidence suggests that humans discount the long-term future at lower rates than the short-term future. This pattern is called hyperbolic discounting. Many policy papers also advocate discounting long-term projects at lower rates than short-term projects. Why do market discount rate and psychological and policy discount rate move at different directions with the increase of project duration? Puzzle 4. It is free to accumulate any amount of credit card debt, which often pays interest as high as 30%. This is defended as freedom of choice. Why it is mandatory for people to deduct their income for retirement, which typically yield a very low return. From the deduction rate and payment rate, it can be implied that the return on CPP, Canada Pension Plan, a government pension plan, is around zero. While the pension deduction, which is mandatory, has been increasing over time. Understanding these puzzles about discounting rates. After presenting these puzzles, we will try to understand them one by one. Human discounting rates. Experiments. Depending on the designs of the experiments, results vary. Overall, discount rates for humans are very high. If showed pictures of beautiful ladies before surveys, discount rates can be extremely high for men. What determines human psychological discount rates? For human beings, it is from our evolutionary past. In old times, the probability of death is high. Hence, the discount rate into the future is high. Credit cards rates at about 30% per year seem normal to many people. They don't have strong enough motivation to change to different methods of financing. This resolved the first puzzle. On the second puzzle, we have discussed earlier that human psychological discount rates are very high. We also learned that low discount rates stimulate economic growth. To stimulate economic growth, we need a low discount rate, which can be most easily maintained by government actions. In practice, governments, through central banks, provide lendings to banks at a low interest rate. All other interest rates are anchored around this low rate. Low discount rate environment increases equity value and encourages economic growth. Summary: in modern society, we prefer discount rates that are lower than human psychological discount rate. Low discount rate can be more effectively managed by central banks instead of directly determined by financial markets. This resolves the second puzzle. Consequences of low discount rate policy. Low discount rate policies benefit borrowers instead of lenders. As a result, Saving rates in countries of low discount rates, which include all the wealthy countries, are low. It favors high fixed cost investment as the borrowing cost is low. Long duration investments are highly valued as future earnings are highly valued. Assets values are high. Fertility rates will be low due to high fixed cost in the society. The society will eventually decline due to below replacement rate fertility and population aging. On the third puzzle, there is a relation between discounting, duration, and uncertainty. For the same project, longer duration means higher uncertainty. For different projects, only low uncertainty projects are designed to last long. Resolution of the third puzzle. Low discount rate is associated with low uncertainty, long duration systems. So human minds associate long duration with low discount rate. Yield curves are about the same types bonds. Longer duration means higher chance of defaults, so corresponding discount rate will be higher. This resolved the third puzzle. Policy implications. We should not force low discount rates on long-term issues if uncertainty is high. Massive funding are poured into climate change-related projects, such as corn and sugarcane, ethanol, carbon offsets, electric cars. The excuse is that these projects will have massive long-term benefits. We don't really know, but we do know this funding are the source of massive fraud. Preconditions for low discount rate policy. Rapid economic growth has to be possible. An important constraint is the availability of natural resources at a low cost. We also need an environment that is relatively free from pandemics. Effective selection and monitoring systems have to be developed to distinguish projects with genuine high growth potential and projects with low probability of high growth potential. These systems are very expensive and prone to errors in long-term forecasting. Some examples are the various green energy projects. Limits to low discount rate. In a paper written by Ansley and Herrnstein in 1981, they wrote, the biological value of a low discount rate is limited by its requiring the organism to detect which one of all the events occurring over a preceding period of hours or days led to a particular reinforcer. As discounting rate falls, informational load increases. Without substantial discounting, a reinforcer would act with nearly full force, not only on the behaviors that immediately preceded it, but also on those that had been emitted in past hours or days. The task of factoring out which behaviors had actually led to reward could exceed the information processing capacity of a species. High discount rate environment. Low discount rate environment requires active policy and institutional support. High discount rate environment requires less active policy or institutional support. Hence, it is a passive and a low-cost environment from institutional point of view. However, at this moment, we may not wish the discount rate to be as high as human nature deems it to be. Institutions and policies will still work to keep interest rates lower than the pure market rate. Policy recommendations: a higher interest rate is preferred, but how much higher? We can let the market take on more active roles. Governments only insure small depositors instead of large banks as well. Interest rate will increase to reflect the risk. In countries with two-tier financial systems, such as in China, it is often difficult for private business to obtain loans. Illegal but common practice is to set up private credit unions to attract deposits and make loans. Deposit rates are much higher than official rates from banks. This shows that discount rate without government guarantees are much higher. But doesn't a higher discount rate lower the rate of economic growth? If the amount of fuel is unlimited, driving at a high speed will get you further. If the amount of fuel is limited, driving at 6 km per hour will get you further than driving at 150 km per hour. Low discount rate does stimulate economic growth over short term. However, with little growth prospect in real economy in most parts of the world, money, which is made abundant under low interest rate environment, is concentrated in real estate, stock market, and commodity speculation. This is what caused eventual collapse of the financial system in 2008. In the living world, a system is only sustainable if its biological return is non-negative. In any society in which the fertility rate is below replacement rate, policies that promote economic growth will make the society less sustainable. Past, present, and future. In the most time of past several hundred years, low discount rate, high fixed cost societies are more competitive and spread out. However, in the last several decades, the trend has reversed. Low discount rate, high fixed cost societies face below replacement fertility rate and population aging. High discount rate, low fixed cost societies are spreading out. It is time to reconsider and reverse low discount rate policy. Reference: for more systematic discussion, please refer to The Nature of Discounting from the Structural Change and Economic Dynamics, 2012. Increasing money supply is a more direct stimulus method than low discount rate policy. Analyze the detailed impact of money supply, how it affects wealth distribution, social structure, and fertility rate. Some examples of long-term trade-offs. Painkiller. Many athletes use Advil as painkiller. Advil, as an anti-inflammation drug, reduced the inflammation and hence the healing of athletes involved in heavy exercises. This damaged muscle tissues. Over short term, athletes are less painful and can endure more strenuous exercises. This helps improve their performances. Over long term, tissue damage accumulates. Heroin and drug use. Heroin was once a wonder drug. That is why it was called heroin. This type of drugs generate short-term comfort and happiness. This is why they become popular. To a drug addict, a shot in the arm will stimulate him over a short period, but it will also put him on long-term dependency. However, this type policies and activities are very popular in our society. Low discount rate policy after year 2000. After burst of internet bubble, discount rate was lowered to stimulate the economy. Housing prices rose rapidly, commodity price rose rapidly. Financial crisis occurred in 2007-2008. Low discount rate after the financial crisis. During the financial crisis, central banks dropped discount rate sharply to stimulate the economy. But easy money flowed to commodity speculation, driving oil prices from 20s to near 100 over a short period of time. High commodity prices increased the overall cost of economic activities, stifling recovery. Global economic slowdown, together with new technology in drilling, caused sharp drop in oil prices. Canadian central banks dropped its rate again at January 2015. Overall, low discount rate policy generates great uncertainty in economic life. Increase of pension premium benefit. Seniors can get higher retirement benefits. Cost. Young people get less cash incomes. Young people are the ones who raise kids. Less income for young people means lower fertility. Senior care, short-term and long-term. Increased input to senior care improved its quality, but it reduced resources for the next generation. With less resource to next generation, less next generation is produced. With less future workforce, the quality of senior care is threatened over long term. Social safety net and saving rate. We all try to avoid uncertainty. Social safety nets are established to countervail negative shocks. But with extensive social safety nets, there is little incentive to save. In most countries with highly developed social safety nets, saving rates are near zero or negative for most people. The reduction of uncertainty at individual level increases uncertainty at social level. In many rich countries, governments accumulate large amounts of debts. Cell phone use. Many people check cell phone regularly in classrooms. This greatly reduced the effectiveness of learning. Many even check cell phone regularly while driving. This is the cause of many accidents, short-term satisfaction, and long-term consequences. Women's participation in labor market and the labor shortage. When there is a labor shortage, women are encouraged to join the labor market. This relieves labor shortage over short term, while the increased labor participation of women reduces fertility rate, which will intensify labor shortage in the future. Concluding remarks: the choice of discount rate has long-term consequences. Many central banks fine-tune discount rate to improve short-term economic performances. However, short-term monetary policies have long-term consequences, which often do not concern policymakers and general public as much. They don't fully understand the precise relations among the various factors in social and economic activities.